Welcome to the Institutional Briefing. Right now, there is a massive macro divergence in the market. Retail investors are chasing volatile AI software and individual chips. The smart money, however, acquires the underlying physical infrastructure. Nebius is the ultimate full-stack platform, controlling the AI future from data training to production deployment. They are not building apps. They are operating as a compute monopoly, aggressively cornering the industry's most persistent physical constraints: power and global compute capacity. Let's look at the quarterly catalyst that broke Wall Street's models. Nebius has reached escaping velocity. Q4 group revenues hit $227.7 million, an explosive increase of 547% year over year. The engine behind this is the core AI business, which generated $214 million in Q4, up a staggering 802% year over year. They completely shattered guidance, closing 2025 with an annualized run rate revenue of $1.25 billion, crushing prior estimates of $900 million to $1.1 billion. The trajectory from here is unprecedented. Management is targeting an ARR of $7 billion to $9 billion by year-end 2026. That is a roughly 7x annual expansion, scaling top-line revenue at a multiple rarely seen in physical infrastructure. More importantly, they are proving operating leverage. Nebius achieved its first quarter of positive adjusted EBITDA at the group level, posting $15.0 million in Q4. The core AI infrastructure unit is now operating at an elite 24% margin. The true institutional advantage isn't software, it's power. Nebius has upgraded its guidance, weaponizing its balance sheet to target greater than 3.0 gigawatts of contracted power by the end of 2026. On the hardware front, they are transitioning from NVIDIA B300 and GB300 chips to being among the first globally to deploy NVIDIA Vera Rubin NVL72 systems. They are backing this up with an aggressive physical footprint, expanding to 16 global sites across the US and EMEA. If you think Nebius is just a sandbox for startups, you are mispricing the asset. They have successfully pivoted to serving mega-cap enterprises. In late 2025, Nebius delivered massive capacity tranches on time to both Meta and Microsoft. This is Tier 1 institutional de-risking. When hyperscalers rely on your infrastructure, it completely validates the underlying tech stack and network architecture. Beyond cloud compute, we have the Avride subsidiary, acting as a massive physical AI catalyst. In December 2025, Avride officially launched a commercial robotaxi service on the Uber platform in Dallas. The smart money is heavily involved here, with Uber deploying strategic investments of up to $375 million into Avride. Furthermore, they are dominating last-mile logistics, completing over 316,000 U.S. robot deliveries via partners like Grubhub, Shake Shack, and Wendy's. To properly value Nebius, institutions use a sum-of-the-parts framework that factors in surgical M&A and deeply embedded strategic stakes. In February 2026, they acquired Tavily to integrate real-time agentic search infrastructure directly into the cloud platform. Additionally, they hold a massive minority stake in ClickHouse, a platform recently funded at a $15 billion valuation. Add in their 1010 EdTech subsidiary, which generated 88% year-over-year revenue growth in 2025, and the ecosystem is highly lucrative. To remain entirely objective, we must address the bear case driving retail fear. It boils down to three primary risks. First, massive CapEx burn. Retail fears the fact that the company burned over $2.0 billion in Q4 alone for GPUs and data centers. Second, hardware supply chain. The model has a total reliance on securing NVIDIA chips on acceptable terms. Third, hyperscaler competition. They are battling legacy tech giants equipped with infinite balance sheets. However, the smart money reality takes the exact opposite view. First, the capacity arbitrage. Demand vastly outpaces supply, which allows Nebius to sell future capacity well in advance, locking in revenue. Second, capital efficiency. Their focus on owned data centers drives highly attractive long-term unit economics. Third, unprecedented scale trajectory. Projecting growth from $1.25 billion to $9 billion in ARR within 1 year proves an extreme level of execution. This creates the ultimate market blind spot. Retail misprices CapEx, viewing massive capital expenditure as a liability. Institutions view it as defensive asset accumulation. Securing 3.0 gigawatts of power creates an insurmountable physical barrier to entry. By hoarding top-tier NVIDIA GPUs, Nebius effectively starves smaller competitors of the requisite hardware to scale, locking up the market. Looking at the technical framework, we can clearly identify the institutional accumulation window. The chart reveals a highly reactive zone where smart money consistently steps in. Retail algorithms might react to broader tech sell-offs, but institutional capital utilizes these exact support floors as prime entry points to accumulate the underlying infrastructure assets. However, the actual price sits on an undiscovered zone and surely will touch the last year maximums and react, and potentially in the future return to the reactive zone. The data speaks for itself. 3.0 gigawatts of secured power, hyperscaler validation, and a clear trajectory to $9 billion in ARR. While retail speculates on which AI software will win, the institutional play is to accumulate the physical toll booth that powers it all. The opportunity is right there on the screen.